Hello everyone, welcome back. In the previous episode, we established the framework of the Capital Relay Watchlist. After AI chips, semiconductors, and AI cloud began to be re-examined by the market, capital would not simply leave the stock market. Instead, it would quickly search for new areas of support across different sectors. Today, we are upgrading the stocks in this watchlist and adjusting the core names to 4: Johnson & Johnson, CME Group, AeroVironment, and Eaton. J&J represents defensive healthcare cash flow, CME represents financial market infrastructure, AVAV represents the high beta direction of defense unmanned systems, and ETN represents power infrastructure that AI data centers cannot avoid. Together, they answer one question. If we do not chase AI at its highest point, what might capital look at next? 1. First, the market overview. The AI trade is not over, but the market has already started to segment. This week, US stocks continued to rise on the surface, but the divergence between strong and weak names intensified. What the market is truly rewarding now is this: who can prove that capital expenditures can turn into revenue, profit, and free cash flow? Conversely, any company that keeps burning money and expanding investment without showing clear returns will be repriced. At the same time, interest rate risk has not disappeared. The Federal Reserve did not raise rates immediately, but long-term rates remain elevated, and the market is still evaluating inflation, oil prices, and geopolitical risks. If interest rates continue to cap valuations, every rebound in high-valuation tech stocks will run into a ceiling. 2. Our analytical framework. Do not chase the biggest gains. Look for 3 types of validation. In this episode, we continue to look for areas that have already shown validation but have not yet been fully priced in. There are 3 specific criteria. First, is there a real catalyst? Second, is there financial or order validation? Third, is there sustained capital attention? Whether a stock rises for one day in the short term is not important. What matters is whether there is buying support on pullbacks, whether there is volume on breakouts, and whether the stock can continue to strengthen after good news. Under this framework, we are adjusting the watch list into 4 directions. For defensive healthcare, watch J&J. For market volatility and interest rate trading, watch CME. For defense unmanned systems, watch AVAV. And for AI power infrastructure, watch ETN. The first stock is Johnson & Johnson. J&J is positioned as a defensive platform within the healthcare sector. Its value lies in sufficiently diversified businesses and relatively stable cash flow. From a trading perspective, J&J is not suitable for a chase-high approach right now. After closing near $256 on July 31st, the first watch zone can be placed at $254 to $256. If the stock repeatedly finds support there, it means defensive capital is still present. The more important support zone is $250 to $253. If the stock falls to that area without any deterioration in fundamentals, it can be reassessed for a potential second opportunity. On the upside, $260 to $263 is the short-term recovery zone. Only a renewed breakout and stable hold near $270 would truly open up upside space. For risk control, if the stock breaks below $250 and cannot quickly reclaim that level, it should no longer be treated as a strong defensive stock. If it further breaks below $248, it needs to be reassessed. The second stock is CME Group, which corresponds to financial market infrastructure. Right now, the market is trading AI earnings, rate expectations, oil prices, inflation, currencies, and equity index volatility every day. When uncertainty rises, the real beneficiaries are not necessarily those who correctly predict direction, but the platforms that provide trading, clearing, risk management, and market data. CME reported second quarter revenue of $1.7 billion, operating income of $1.1 billion, and adjusted EPS of $2.99. From a trading perspective, CME currently looks more like a trend-following stock. The first short-term confirmation zone is $270 to $272. If it can hold this range with volume, it would show that the trend remains strong, and the next area to watch would be resistance around $280 to $285. If there is no breakout, do not chase after consecutive gains. On the downside, $260 to $263 is the first pullback watch zone, while $255 to $258 is the more important support zone. If the stock breaks below $255 and cannot quickly reclaim it, it would indicate that this round of pricing driven by market volatility and trading volume may be starting to cool, and the setup would need to be reassessed. The third stock is AeroVironment. It is a high beta name in defense unmanned systems, so position sizing must be small and confirmation should be awaited. It represents the direction of defense technology in unmanned systems. AVAV is more concentrated in subsegments such as drones, counter-drone systems, loitering munitions, space, cyber, and directed energy. AVAV's revenue reached $641.6 million in the fourth quarter of fiscal 2026, and full-year revenue was approximately $1.977 billion, representing significant year-over-year growth. Full-year bookings reached $2.7 billion, and the company guided for fiscal 2027 revenue of $2.125 billion to $2.225 billion. These figures show that it already has orders, revenue, and future delivery expectations. AVAV is not a defensive stock. Its share price previously regained attention around $150, but it remains clearly below its previous highs, which shows that the market has not fully restored confidence in this type of high-volatility defense technology stock. From a trading perspective, $145 to $150 can be used as a light position watch zone, but it is not suitable for a heavy position. The better core support zone is $138 to $142. A pullback to that area followed by stabilization on lower volume would offer a better risk-reward profile. $130 to $135 is the deep defensive zone and also the area to reassess fundamentals and order conversion capability. On the upside, only an effective breakout above $155 to $160 with expanding volume would indicate that the trend has truly strengthened. If the breakout succeeds, the next area of pressure to watch would be around $170. For risk control, if the stock breaks below $135 on volume, adding exposure should be paused. If orders continue to grow but margins or cash flow fail to improve, expectations should also be lowered. AVAV is suitable for the watch list as a high beta offensive name, but it should not be treated as a low-risk allocation. The fourth stock is Eaton. In my view, it is the one among these four that can best connect the AI main theme with non-AI cash flow. The reason is simple. Data centers cannot operate without power, power distribution, cooling, and power management systems. Capital is moving from only buying AI chips towards searching for the second-layer beneficiaries where AI capital spending truly lands. Chip companies sell GPUs, cloud companies build data centers, and companies like Eaton provide the power infrastructure necessary for data centers to operate. From a trading perspective, Eaton has already risen significantly after earnings, so it is not suitable for blind chasing. The first watch zone is $410 to $416. If it can hold this range, it would show that post-earnings buying support is still present. On the upside, $420 is the short-term confirmation level. If Eaton breaks above $420 on volume and holds that level, the next area to watch would be the previous high resistance zone around $430 to $437. On the downside, $402 to $408 is the first pullback zone, while $390 to $395 is the more important core support zone. If Eaton breaks below $390 and cannot quickly reclaim it, the post-earnings strength may be only a short-term sentiment rebound. If it falls further below $380, the AI power infrastructure trade needs to be reassessed for possible short-term cooling. Eaton's logic is strong, but its current price level is not low. The core strategy is to wait for a pullback or wait for breakout confirmation rather than chase the stock higher. In terms of stability, J&J is the most defensive. CME is a cash flow platform in a high volatility market. Eaton is a second-layer AI infrastructure opportunity, and AVAV is a high beta defense technology name. In terms of aggressiveness, AVAV ranks highest, Eaton comes next, CME is more neutral, and J&J is the most stable. At this point in the stock market, AI-related stocks have entered a segmentation phase, and the market is starting to examine who can truly deliver revenue, profit, and cash flow. At this stage, do not only look at which stock is rising the fastest. Instead, look for three confirmations: whether the stock can continue to rise on volume after good news, whether there is support at key pullback zones, and whether earnings or orders can continue to validate the logic. A stock that continues to rise on volume after good news is truly strong. A stock that does not rise after good news, or even falls on heavy volume, is giving a risk signal.